Hey, Steve Saretsky here. Welcome back to the show. Lots to touch on this week, which is really the key theme. We keep saying this sort of every week in the new year because there's so much volatility in markets right now. Of course, we did a video last week talking about the tariffs and the implications it was going to have on the housing market, particularly how that would impact psychology, uncertainty, right? I mean, it's really hard to go out there and have confidence making a $2 million house purchase if you're not too sure if your business is going to be impacted by tariffs, if you're going to have job layoffs, what revenues look like. It creates a lot of uncertainty. Of course, we put out that video on the Saturday, and by Monday, the tariffs were off. So as of right now, we've got, we've proposed to beef up our borders. We're going to be introducing a fentanyl czar to appease Trump's request around cracking down on the fentanyl stuff. And so the tariffs are now on pause for 30 days. We'll wait and see what happens 30 days from now. I suspect they'll be coming back at least in some shape or form. Again, probably not 25% across the board. Certainly hope not. I think that hurts everybody. But we'll wait and see. If you want to get an understanding of the fentanyl stuff, people say, "Oh, it's not a big of a deal." The Globe and Mail says it's just 1% of the, drug trafficking at the northern border. I highly encourage you to go check out our interview on the Loonie Hour with the fentanyl expert in Canada. There is nobody else like him, Sam Cooper. I would really encourage you to check that out because, again, if you want to understand the tariff war, you have to understand the fentanyl war, and Sam is the guy for that. Very, very connected in the national security space, not only in Canada, but in the United States as well. So again, we're obviously waiting to see what happens with these tariffs. That's been having major implications on financial markets, particularly the bond market, right? Which is the big thing for real estate. Everybody knows real estate's highly levered, particularly in markets like Vancouver, Toronto. And you're borrowing money, we got to watch the bond market because that's what prices your fixed rate mortgages. Those yields, that the 5-year bond yield, which is the one that we watch, which typically prices your 5-year fixed rate mortgage, has been rolling off significantly over the last month or so, over a few years on, again, the tariffs creating a recession in Canada and obviously driving those bond yields lower. We've seen a little bit of a pop up 12 basis points this week, but what we're seeing now is banks, right? So keep in mind, this is essentially a funding mechanism for the banks, right? So when they're pricing their mortgages, they're looking at the bond yields. It's a little bit convoluted, but essentially the savings that we've seen in the bond market with the lower yields over the last week or two, they take time to filter through the system, right? Like if bond yields move down 5 basis points in a day, you don't immediately get a cheaper mortgage tomorrow. It takes time for this to filter through the banking system. So we're seeing now the lower fixed rate mortgages coming through at these large Canadian banks. There was one bank that I was chatting with this week. Again, for the right client, highly qualified, higher credit score, larger mortgage size. We're hearing 3-year fixed at 3.99, 3-year fixed at 3.99. So we're piercing that 4%. And that's again for an uninsured mortgage. And I don't know if that mortgage rate's going to last. Again, if you're borrowing $100,000 and you got an average credit score, you ain't qualifying for 3.99. But just know that it's out there and it's probably coming to other banks as well, given the large movement we've seen over the last number of months. So this certainly helps ease the pain of all the uncertainty around the tariff stuff. But what I'm seeing anecdotally in the housing market, you guys know that I follow this stuff very, very closely. We started off the year, I would say pretty hot. We came and we had that momentum in the back half of 2024. People felt good. Hey, Bank of Canada's cutting rates. There's still a couple more on the table. That momentum would carry through into this year. We saw that in the first couple of weeks of January. And what I've noticed, at least over the last couple of weeks, we're almost now in mid-February, is that momentum has faded quite a bit. We're seeing a lot more buyer hesitation, fewer showings, and it's a very, very mixed bag out there, really. It is the condo market, particularly the investors play, that continues to be saturated compared to your entry-level single-family market, which has a whole bunch of families competing with multiplex builders now. So the two segments, again, are very, very different. And I point this out because if you look at Greater Vancouver real estate stats that just came out for the month of January, right? We just got the data for January. So sales are up, modestly over a very, very weak 2024, still below long-term averages. But where we saw the huge number that is the eye opener is on the inventory side. So the number of new listings for the month of January was the highest on record, dating back to over the last 20 plus years. And so if you actually strip that out further and you say, okay, well, is it across all segments? It's actually almost exclusively concentrated in the condo segment. So condo new listings for the month of January, by far the highest on record. And this goes back to a core theme that I have been mentioning for a number of months. We mentioned it on last week's pod. What we're continuing to see is the investor bid. The investor bid is systemically it's gone. The investor bid is gone, right? We saw a huge influx of it over the last number of years. The math simply doesn't work today. You've got falling resale prices, or call it flat at best. You've got declining rents. You've got economic uncertainty. You've got higher mortgage rates. The numbers don't pencil for an investor. They haven't for quite some time. And so the only reason why people were still willing to invest was the prospect of future rent growth and future price growth, both of which, as I've mentioned, are flat to declining in many markets across this country. And so that investor bid has pulled back. A lot of people that tried to sell investment units last year unsuccessfully, or now sitting with rental properties that are sitting empty for 2, 3, 4 months because they can't get the rent they want or used to get, are now saying, well, hey, maybe it's time to put it on the MLS and sell this thing. And so that's why you're seeing the number of new listings hitting all-time highs in that condo segment, not in the single family space. So again, two very different dynamics. Keep in mind, right, we don't add net new single family houses in markets like Vancouver. In fact, every single year that inventory continues to contract. So you kind of put an underlying floor under that market, as basically what happens is when you upzone things like multiplex, where you can, instead of building one house, you can now put 4 units or 6 units, because you actually increase the land values by doing that. You, as a developer builder, you're simply looking at the pro forma and saying, if I pay this for the land and build these units, can I make money? A yes or no? That is the question. And so what we're seeing today is that the multiplex, it works. It works in markets like Burnaby. It works in markets like Vancouver for certain lots. The math does work. The math is relatively tight. You got to be dialed in on your construction costs. You got to know what you're doing. If this is your first time building a multiplex, you're probably going to lose money. But if you got some experience and a track record and you manage your construction costs, the numbers do pencil out, and that's putting the underlying bid under the land market. So all this to say is, again, we're continuing to watch the tariff stuff. I found it interesting. You'll notice that there was a huge pop in Canada's labor force statistics. And so I want to point that out because I think it's very, very important. So we've seen a huge jump over the last 2 months, including the day that I'm recording here today, the jobs numbers coming out of Canada, huge bounce, higher than expected job growth. And everyone goes, that doesn't quite add up. What's going on? I thought we were entering a recession. I thought the economy was weak. We've got declining rents. I mean, how often you get declining rents in a non-recessionary environment? Well, I want to point this out. We've got this on good, credible sources here over the years that we've built up, that there is a large divergence happening right now between the labor force survey, which is the data that was just released today, which is a household survey, is showing 2% annual growth, including a 90,000 increase last month in December, in the number of jobs added, which is in stark contrast to what's happening in the Canada Survey of Payrolls, Employment and Hours, which has posted declines in 3 of the past 5 months, and is now reporting a negative private sector payroll growth on a year-over-year basis for the first time since the pandemic. So if that sounds like a mouthful, basically what I'm saying is there's 2 labor force sort of survey datas, and they're going in opposite directions. And this is because the labor force survey, which is the one you're reading in the Globe and Mail or the CBC News, they're talking about, oh my gosh, strong jobs growth, and everyone's kind of scratching their head. It's because what they do is they take immigration data, non-permanent resident data, and they basically extrapolate those projections. So they're using a model, and models are not perfect, particularly in times of inflection points. And when I talk about inflection points, I'm talking about massive changes to Canada's immigration system. Again, remember, we've gone from adding 1 million people a year into this country to all of a sudden the government says, whoa, we got to take immigration growth to 0. You're going to have some big changes in your model. And so this is, I have it on legitimate reason and legitimate sources to suggest that there is some issues on the modeling side, monitoring this inflection point. And so we'll wait. We'll see how this shapes up. But don't be surprised if this turns out to be a head fake. Obviously, this is important, right? Because the bond market is pricing this data. Financial markets are pricing this data. I mean, if you're a homeowner, you might be looking at it and saying, hey, I feel pretty good. The economy's looking okay. This is, I think, something to watch. Why are these two surveys diverging in very different areas? And again, I would probably ask you guys in the comments, do you think the labor market is heating up, or do you feel it's getting worse? I mean, it's a simple question that I think is worth asking. And I think the problem is on the non-permanent resident side. Keep in mind, we do not track outflows. We do not know if somebody leaves this country. As of right now, the Canadian government does not track outflows. They only track inflows. So basically, they just do their best to track. They basically do their best to model outflows, but they don't actually count. They're not actually asking people if they leave. And so I think that this is the challenge with these models and these data sets is when you get these large changes very quickly, they take time to adjust, and models are not perfect. And so this is something that I think is worth monitoring. Again, I look at it and say, well, okay, hold on a minute. Everyone that I'm sort of seeing and hearing anecdotally is saying the labor market's slowing down. It's taking harder and longer to find a job. Rents are declining. Vacancies are way up. This is not something you typically see. There's a good data source that was pointing out from a good friend of the show, Ben Rabideau, showing that the growth in telecoms. So telecom growth, right? I mean, if you're coming here as an immigrant, you probably need a cell phone. So you're going to, let's say, Bell Canada. And if you're seeing the growth rate in new users at Bell Canada drop significantly, I think that's probably a decent leading indicator to suggest, maybe there's fewer people in the country as more people leave. So I think that's something to watch moving forward. Like I said, I think the key message this year is going to be uncertainty and volatility. On the mortgage rate side as well, guys, we've gone from 6.3 down to 5, down to 4, back up to 4.5. Now we're back down to basically low 4s, sub 4 in some circumstances. Don't be surprised if in 3 or 4 weeks that's back up to 4.5. So again, if you're actively searching for real estate or looking for a mortgage renewal, you should be hitting the phones right now and trying to lock in rates, at least to hedge your risks. That, again, at least in the worst case scenario, if those rates do pop up, that you've locked in this temporary reprieve of yields. And if they do, in fact, move lower prior to your closing, that you can always re-up at the newest, lowest rate with your lender. So hope that helps. We'll continue to monitor things as we move forward week by week. See you next week.